Welcome to SilverOak's quarterly webinar. With me today is Jonathan Charlo, partner of the firm and also our lead analyst. And of course, I'm Shannon King, president, partner, and chief compliance officer. Our webinar is scheduled for 45 to 60 minutes, and a copy of this will be posted to the SilverOak website afterwards. If you have any questions throughout the webinar, I encourage you to contact your SilverOak advisor at the end of the session. If you're not currently working with an advisor here at SilverOak, feel free to contact me directly at 952-896-5701. And as usual, I want to thank Jonathan and John and the rest of the SilverOak team for making today's webinar possible, including everybody behind the scenes on the IT side as well. For compliance purposes, I need to remind everyone on today's webinar that we will be discussing the overall markets and economy during today's session. In doing so, we will be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. Also, we will not be discussing specific SilverOak portfolio performance as each of our client portfolios are customized. Nonetheless, everyone should have received their customized performance reports within the last couple of weeks. If you have any specific questions on those reports, please, again, reach out to your SilverOak advisor. And of course, lastly, past performance is no guarantee of future success. So with that, Jonathan, let's take a look at the agenda. As usual, we'll start our discussion with economic data and a review of the quarter. We'll also go into the market data for the quarter. We're going to have a section today on transitions, and Jonathan, you're going to mention several transitions, maybe major transitions that we seem to be going through currently. And then we'll go into SilverOak's outlook, provide a few updates on internal happenings, and of course, we encourage any questions to be directed to the SilverOak advisor you're working with or to me. So let's start with the economy. I see here, Jonathan, you say the pace of recovery slowed during the third quarter. So tell us, what do you mean by that?
We did see growth in the third quarter, but when we look at what growth likely came in at, it was definitely less than what economists were expecting earlier in the quarter. I think the issues out there are the Delta variant. It did affect consumer spending and confidence, and then the supply chain also was a factor in kind of lowering what growth would have been otherwise.
Sure. And actually, that's going to be one of the major transitions that we talk about, or at least a component of one of the major transitions we discuss later. In the meantime, let's look at the market dashboard and see how we ended. Now, if everyone remembers, our dashboard is made up of four major categories, including one of them being the economy. And you can see for the third quarter, it was a positive assessment. So green is positive, red is negative, and the grayish is neutral. If we look at the next category, credit markets, they continue also to be in the positive categories. Valuations tend to be in the negative category and have been for a while. Now, we're going to talk a little bit about valuations later, and it seems like maybe they've getting a little bit more reasonable, although still inflated.
More reasonable, but still relatively high. Okay. So it's going to take a while before valuation on the dashboard becomes more neutral.
Sure. Okay. And then the fourth component is market sentiment. That also has remained positive. And with all of that data, we actually shifted the overall composite from being more neutral to being more in the positive category. And of course, all the underlying data to this is quite detailed, but if we put it on this dashboard chart here, we can see that everything is really upward moving. So we're well above what we consider to be important thresholds. So the 4.42 on the current dashboard or the 4.13 on the 6-month average dashboard, both of those are above those thresholds that I just referenced. As we look at the next data points, we'll see the economic factors and our scorecard. And here on the far left, under the positive economic factors, you'll see corporate earnings. Now, if you looked back at our prior webinar, corporate earnings were actually under the neutral category, but Jonathan, you have shifted that over to be positive.
Yeah, so for the year, earnings recovery has been very, very strong. And so far, what we're seeing in the third quarter is again, very strong earnings. We've seen several of the major banks kind of early on, and earnings seem to be kind of in line. This is going to be a quarter that people are going to look at inflation and what that does to margins. But it does look like revenue and earnings are at levels that people have expected.
Sure. Now, there are some signs that other categories here are not doing quite as well. So the down arrows really signify not shifts from positive to neutral or neutral to negative, but just that the sentiment is maybe shifting a little bit more on the downward side. Do you want to walk through a couple of these?
Sure. So on the positive column, we have a negative arrow for interest rates, which reflects the fact that this year interest rates are generally up. We also know that the Fed has talked about raising rates modestly at some point next year, but we've definitely, and we're going to show this later, think that longer term interest rates, which are more governed by the market, will continue to move higher. Now, under the neutral column, we have a negative arrow for commodity prices, and we'll also talk about that later. But commodities are in tight supply this year. Oil, a lot of the other sort of legacy energy commodities are in short supply, and prices are rising. Now, again, a lot of this will impact US inflation. And so we do have a negative arrow because, again, more recent numbers have been coming in that 5% year over year level, which is hot. Now, remember, it's probably more like 3% if we look at it versus 2019, but it's still probably running in that 3% plus level, and we could see that for some time. Now, global growth expectations, we do have a negative arrow. They've only come down a little bit. I think that really was more the thought that global recovery might be a little bit faster, but with the Delta variant, I think that got pushed out just a little bit. And then finally, in the negative column, China has a negative arrow. You've probably been following it. We are going to talk about it in greater detail later, but needless to say, China growth is slowing, which has negative implications globally.
Overall, though, I mean, we touched on a lot of the negatives, especially there at the end of that discussion. But if we look at all these components, I mean, they're obviously heavily skewed toward neutral to positive. So
absolutely,
you know, things are coming down, but coming down from a high.
Correct.
So consumer activity, that also, though, flattened a bit during the period.
And again, I think that had a lot to do with the Delta. It did dent consumer confidence, and we saw activity levels kind of flatten out. So if we look at the travel and leisure area, you're going to see that, you know, TSA travel traffic is still down from before the pandemic. Open table or seated dinners are still down. Now, interestingly, in October, I did look at the open table data, and that is actually getting better. And as we kind of discussed earlier, interestingly, open table data in Europe has actually improved quite a bit. But again, it was a little less than we would have expected earlier in the quarter. But again, it looks like things are getting better as we're seeing kind of headlines with the Delta variant that nationally it seems to be declining again.
Sure. But I want to mention consumer activity is so important in our discussion because the consumer really drives 2/3 of the overall GDP. So if we have confident consumers that are out spending, it's really hard to go into a recession. On the flip side, if consumers stop all of their spending and they become more pessimistic, that could be negative to forecast. So let's go into the next slide, which is going to give us information with regards to GDP. And this is really encouraging in that GDP is actually back to pre-pandemic levels, but not quite to the trend line. And we'll see that there with that slight gap.
Yeah, the encouraging thing though is we are expecting good growth next year. And if we see the growth kind of at expectations, we are likely going to hit that 2% trend line growth. And so that means that we'll have recovered in 2 years versus post 09, we didn't actually get back to trend line until 2017. So certainly, I think the vaccines helped. I think fiscal support helped. The Fed helped, but it has caused, the fastest recovery.
Right.
We've also talked about how the recession was also very short.
Right. Yeah, the shortest I think on record. So pretty amazing. If we look here, the jobs market remains tight, and everybody, I'm sure, by just reading headline news or listening to headline news, are well aware of labor shortages that we've seen, which has been putting a little bit of pressure on wage growth, but still nothing completely ridiculous given the circumstances.
Yeah, the only thing, and we talked about this earlier, is you've probably started to see some headlines of union strikes. So that is something that we're going to have to watch going forward. But I do think that with the pandemic, the way work has changed, with all of the demand, I think a lot of manufacturing and transportation workers have been working a lot of overtime. The pay has been going up, but I also think they realize that in this type of labor market, they do have some power.
Sure, yeah, and may start to exercise that power, especially through collective bargaining actions. Inflation, as we just mentioned, wage growth is a little high, and we see kind of overall inflation here a bit over trend lines.
Yeah, so the only thing I would say about that is that, we're going back to kind of where we were in the late 90s, but again, we're looking at year over year. And so we're comparing against periods in the pandemic where we actually saw disinflation.
Yeah.
And so if we look at it versus 2019, it's higher than the Fed expectations, but it's probably more in that 3% level. And so I think wage gains, inflation expectations, and kind of the tight supply chains and how those are resolved will tell us a lot about what future long-term inflation will be.
Sure. Well, and we touched a little bit on this one, Jonathan, and that is the earnings rebound. But it's been pretty encouraging to see the data coming so far for third quarter.
Yeah, absolutely. Again, it's been strong. It has met, if not exceeded, expectations by a little bit, but it's going to be a strong quarter.
Of course, next year, when we start looking at year over year expectations, that might be a little bit more challenging, but so far it's been quite encouraging.
Yeah, absolutely. We'll talk about it later, but there are some other transitions from the government level that I think get into this. But if we see modest earnings growth next year, I think that's very conducive for the markets.
Okay. Well, and earnings are so important. Kind of like the consumer is so important to GDP, earnings are so important to the markets because they really drive market performance long term. So let's look at what the markets did for the quarter. And unfortunately, the quarter wasn't really the best on record. As a matter of fact, most of the equity markets were break even to in negative territory. Now, on the bright side, it has been a very, very strong year so far. So year to date, you're going to see all of the US markets still up double digit. International still up almost 6%. Emerging market, that's getting hit from the discussion we had earlier about China. That's been a pretty big drag on the emerging market category. And getting back to our earlier discussion as well about interest rates. You mentioned, Jonathan, that interest rates had gone up throughout the year. and that then has a negative impact on performance of bonds. And so you're going to see the Barclays down about 1.5% year to date, while the global bond market's down a bit more. Now, again, always like to end a discussion on a slide with positive. Commodities up considerably for the year, and that really is driven into some of those legacy energy names and components that you had made reference to. And then REITs, after COVID hit and everyone thought, real estate was done, REITs actually were up 22%, or at least so far this year are up 22%.
Mm-hmm.
So if we break down then the third quarter and year to date by capitalization and by style, you'll see here on the left for the third quarter, small cap growth was the worst performing, although there wasn't a big differential across any of these categories, quite frankly. On a year to date basis, kind of the same story, maybe a bit more dispersion of returns with small cap value doing the best, while small cap growth year to date doing the worst. But I'm not really going to complain much about that chart there, because most of those categories are double digit.
Yeah, absolutely. I mean, again, we talked about this, but U.S. returns really have been the best.
Yeah, and we were talking earlier before the webinar that a lot of the returns still are being driven off of a handful or maybe a dozen different U.S. large cap technology type stocks.
Yeah, absolutely. So large cap growth being up 2% in the quarter, blend being up, really that's just from the growth side. That really was what did best in the third quarter.
So unfortunately for the quarter, international returns weren't quite as strong, nor have they been a strong year to date. Not quite as bad as the quarter if we look at the year to date numbers, but tell us which part of the markets are doing the best.
Well, interestingly, we have always felt that as the pandemic went kind of through its stages, that vaccination rates in Europe would play catch up and Europe would do better. So Europe was actually down in the quarter, but is really standing out internationally. And so I think relatively speaking, we were right on Europe, maybe wrong on absolute returns so far, but I think it's really everything to the left. It is China, and you mentioned how much that affects international returns and especially emerging market returns. And I think more broadly, we also saw the pandemic really affect Asia a little bit more in the third quarter than what we even saw last year. And of course, we know that Latin America this year has been ravaged by the Delta variant. So again, it seems to be a bit more pandemic related, which would get better with more vaccinations, but the wild card is China.
So let's briefly touch on bond performance. And I already mentioned with interest rates up, performance is not nearly as strong as maybe has been in the last several years. What part of the bond market has shined over other parts?
Well, there's really two areas. One would be tips. And so we've talked about inflation. And so with inflation expectations going up, tips have done better. So that shouldn't be a surprise. I think the surprise though might be high yield and how well it's done. Now, certainly with government support, both fiscally and through the Fed, we've actually seen a very low default rate. But it is kind of surprising that it would still have even been up in the third quarter. But I think investors are kind of, with low interest rates, stretching for that yield, and they're buying CCC bonds. That's really not part of our bond philosophy, but they seem to feel that this is an environment of low default risk, and so they're willing to stretch and take that credit risk.
Well, with that, let's transition over into a discussion about transitions. So since we touched on the economy and we touched on the markets, let's just talk about these big picture transitions that we seem to be going through. And whenever I think about transitions, there are all different types of transitions. And as you know, Jonathan, as well as I do, we're going through transitions throughout our lives. And some are great. You got the birth of a child or a marriage, and they bring really good feelings. And unfortunately, some maybe are transitions that are more scary. Divorce or the loss of a loved one, that can bring a lot of stress. The markets are always going through transitions, as is the economy, and at times it's euphoria and at times it's not. So let's touch on the big picture economic transitions first. So you've got here listed several: supply chain, labor force, commodity prices, China growth, consumer spending, and inflation. And we've touched a little bit on most of these, but let's start with the supply chain.
So here
where are we with
we're showing a picture of all of the ships off of the ports of Los Angeles and Long Beach. And so you've heard this in the news: 40 to 50 ships, taking weeks to unload them. This is a transition. We don't know exactly how the pandemic will necessarily go, but it seems like we're moving forward with vaccinations. Maybe we go to an endemic phase. But we do know that the consumer is in a good situation, and we'll kind of show that later. But demand for goods is up this year. Now, I think part of this is some seasonality too, because we do get a lot of goods from China coming in for the holidays. But one of the other things we'll talk about is labor force. It is tough to get the warehouse workers, the ship workers, to take the goods off of the ships. That's a bottleneck. There's a shortage of truck drivers and even the trucks that can hold the containers. And then when we get into the warehouses are in workers are in short supply. So, it's going to be tight this holiday season. But the other side of that is that once we kind of get in the post-holiday period, and once the goods are delivered, this could actually get a little bit better.
Sure. Well, and it's amazing to me as I think about transitions, and you and I have touched on this before, but not too recently. It was amazing the transition that we went through last year with the pandemic, where prior to the pandemic, we were going out, spending our money on, in restaurants and the movie theaters and all of these different activities, travel, etc. The pandemic hits and we shift, right? The consumer likes to spend. That's the one thing you can rely upon U.S. consumers to do, is to spend. And they transition their spending from restaurants and movie theaters to grocery stores and downloading or streaming movies. And it's just amazing how quickly we are able to adapt. And essentially, that's probably a big reason why it was the shortest recession in history, is that we made these transitions and we did it really, really quickly. And now we're trying to transition back into a, as you mentioned, post-pandemic era.
Yeah, and I think on top of that too, you have to just think about the global supply chain that we created over the last 30 years. It was designed to be kind of a well-oiled machine. And then you bring the pandemic and shifts in spending and consumer demand, as well as pandemic, lockdowns and mitigation measures hit supply chain. And so it will right itself over time, but this is kind of what we're seeing as a result.
And of course, you touched on the labor markets earlier, but we're seeing transitions there as well.
Yeah, absolutely. So we do know that essentially unemployment is coming down. Now, on this chart, we're kind of showing the range in unemployment.
So this is the left chart.
The left chart, pre-pandemic, and then the diamond at the top is as of July. Now, obviously, unemployment has come down from there, but there's been clearly a shift in unemployment since the pandemic. Now, back in 08, 09, clearly the same. Now, I'd say the recovery has been quicker, but the issue really is on the right side. which is that we don't necessarily think that we're going to snap back quickly from here. Now it's a little complicated. The blue lines are essentially showing that the participation rate among different parts of the workforce are below where they were pre-pandemic. And so one of the things we've heard is that women have not gone back. And I think a lot of that has to do with what's gone on in the schools and with childcare. You know, so maybe they come back, and certainly for prime age men, that has been less of a factor. But I think it's really the thing on the far right, the civilian labor force 55 plus. And one of the things we're just hearing is that workers in their early 60s might have retired. And we saw that back in 08, 09 as well. It seems to be happening again. And so we've been kind of stuck in the 62% labor participation rate. We might actually be headed a little lower as a result. And so this has implications for employers. How do they deal with such tight labor markets? And if people don't come back, we could be in a chronic labor shortage for years.
And it could bode for a shift too in some positions, transitioning to more technology. I mean, I'm just thinking like restaurants. I mean, it's not unheard of. As a matter of fact, it's quite common these days to go in and you don't have the server in person like you used to. You've got, you know, the QR code that you got to look up, and you order online, even though you're sitting in the restaurant itself. I just had that experience over the weekend. I went to a restaurant, a vegan restaurant here in town, and they no longer have servers come to you to take your order. You have to do it while you're sitting in the restaurant, order it online, and then somebody brings it to you. That's it. That's your only interaction. But that's a very simple example. But if we can't find labor and there's a shortage and we don't get the participation rates that we hope to bounce back to, I can imagine that technology will take over some of these roles much more quickly than otherwise would have been the case.
Absolutely. And another way to think of it is business models will change as a result of short labor. So I'm going to admit my guilty pleasure is DQ.
Yes.
And
they
so
close so early. Is that what you're getting to?
Well, there's that. Plus, it's really drive-through lines.
Oh, that's true too.
They've kept the inside closed. And quite frankly, what if they decide that's the model they want to go to?
Right.
And so they would need less labor, still be able to deliver their product. But there's just so many ways on the positive side that businesses can react to this.
Yeah. No, I noticed that. I went there 8:30 one night and they're closed at 8. It's like, really? Wow. In any case, oil prices. So this gets to commodities.
Yeah. So we've talked about legacy energy. And to step back, one of the transitions we're dealing with kind of the idea of ESG and using more clean energies going forward is that there's the expectation that the world will transition over the next 30 years. But in the meantime, we kind of have shortages because global growth is coming back. Europe has dealt with less wind in the North Sea. So wind power is down. They've reacted by getting more natural gas. And so natural gas prices are up 5x in Europe this year. Even in the US, I think partially because of the hurricane situation, but partially just due to COVID and drilling stopping when oil prices were low, production just isn't going up. And so we have high prices. But it's not just oil. It's coal, it's natural gas. We've heard about semiconductors and how that's impacting manufacturing in the car markets. But in general, we seem to have a period where we just don't have enough of these commodities in the short run. We don't know how this is going to be long term, but one of the things, and this is a longer term transition, is that demand for cleaner energy seems to be increasing and will over time.
Well, and that gets us into a good discussion on China? Because when I think of clean energy, I certainly do not think of China.
Well, do you know what the correlation between solar panels in China and coal is? They actually use coal in the plants to build the silicon, which is put into the solar panels. And so one of the problems right now is that they don't have enough oil and natural gas as well as coal. And so manufacturing has actually been constrained right now in China. But what we're basically showing here, and we've heard about the property market, essentially China is trying to let the air out of their property bubble without bursting it. And so on the right, we're basically showing that they're constraining credit. That's something we've seen this year. On top of that, they've been cracking down on technology companies and generally being a little bit more regulatory. Now, we're probably seeing them at their low, and they will probably start easing these next year. But if we do see lower growth coming from China, and if they truly are transitioning to a different type of economy, being more internal and consumer based, this has broad implications for global growth, as well as for US and European countries manufacturing in China.
Right. Well, and all this really brings us to something that we touched on, and that's inflation and the risk of longer term inflationary pressures, just not transitory.
Yeah, and so when we started talking about this a couple webinars ago, I would say today we are probably more convinced that inflation is going to be higher than what we thought a couple quarters ago. A lot of that has to do with the things that we're seeing that maybe are being impacted by the pandemic, but we are seeing wage growth. And we've always talked about that if consumer inflation expectations increase, then we probably have longer term inflation. And that's in fact what we're seeing. But the only thing I would mention though, is we're just returning back to consumer inflation expectation levels that we saw maybe 10 years ago. And so we were in a period with lower expectations. So maybe it's gonna be 3%, but that doesn't mean that we're heading to the 1970s.
Right,
either.
and I think that's a big point to make, because the 70s, totally different situation. Not that we can't go to higher inflation, but not likely, at least our base case, to the late 70s or early 80s. With that, let's talk about our market transitions. So we touch on earnings. We may have reached peak earnings. We'll see, but you'll give us some information around that. We'll talk about long-term interest rates. That kind of ties into the inflation discussion. Valuations coming down. We briefly mentioned that earlier. And then volatility likely to increase, with future returns most likely to be lower, potentially across both fixed income and equities. So let's break this down. So earnings.
So basically, if we look at the world, US, developed markets and emerging markets, we've had a just dramatic recovery in earnings from the low of the pandemic. Now, basically the arrow is showing that, and the level is the diamond, we're going to see growth coming down from current levels. Now, it's still going to be nicely positive and could even be double digits next year, but we've, for example, seen some companies with earnings up 65, 70% year over year. We're just not going to see that next year.
And you touched on the interest rates, with, of course, everybody knowing that the Federal Reserve really only controls the far left of this chart. They control the Fed funds rate, the overnight lending rate. It's the markets that really are probably dictating more the far right of this, the longer term rates. And we're showing that we believe that they're going to continue to shift up.
Yeah, absolutely. Now the top interest rate curve is showing back in 13 during the temper tantrum. Now we're not necessarily saying we're going to those levels, but we should see the 10, 20, and 30-year come up from here somewhere in the middle. As we just see global recovery and then growth, we would expect long-term interest rates to come up.
Ideally, if they do, slowly over a period of time. And I think that's one thing to kind of key in on when we talk about fixed income returns. If there's a slow shift in interest rates over a period of time, that's not necessarily terrible for fixed income returns. It's when we see big adjustments in interest rates over a very short period of time that can shock the system a bit and be a bit more negative on bond performance for that period. So valuations. Tell us about valuations here.
Well, with the strong earnings recovery, we are seeing valuations come down. And so basically, at one point during the pandemic, we were kind of fearing that we were back at 2000 levels. But with the strong recovery in earnings, we are seeing that valuation come back in. I'm not saying the valuation is cheap, but it's not as constrained as it was before.
And for those that don't know, there's the negative correlation, right? As earnings go up, valuations come down. As earnings come down, valuations go up. That's generally the way the market works. I love this slide. This is one of my favorite slides. One, because it really shows that throughout most years, we see at some point an intra-year negative return. And yet, in most of the cases where you're seeing negative returns for that single year, the year still ended positive. So for anybody that hasn't seen this, every column is a different year, going all the way back to 1980 on the left to 2000 on the right, and year to date at the very, very far right. The negative number down below, that's the intra-year low for that particular calendar year. And then the shaded area, the bar, is where the market ended for the full year. So as an example, I'll pick one that is maybe a good one. We'll look back at 2020, excuse me, where the market was down 34%, right? That's COVID. That was what, sometime in March or April. Yet the market still ended the year up 16%. So we can see the volatility throughout most years where there's a wide dispersion of returns intra-year. And I think what we're getting to here, Jonathan, is just that we've had pretty small amount of volatility. I mean, we say that there's been an intra-year decline of 5%. That was barely.
Yeah,
I mean, that was barely.
It was September.
It wasn't much more than 5.
It was a blip, and it seems so far in October that we're climbing back up. But interestingly, in an average year, there are 2 5% declines that we've seen historically, and 1 10%. And we clearly just have not seen that so far. But with all these transitions that we're talking about, the potential for a bit more volatility and say another 5% pullback, or maybe even a 10% at some point, that possibility is out there.
And if it happens, history tells us that's pretty normal. Don't get too upset about it. Of course, the last set of transitions we're going to touch on are the government policy transitions. And these are big ones with the new administration coming in. And as you've pointed out a couple of times, the reduction in both fiscal and monetary stimulus.
Yeah, absolutely. And so with the new administration, there are different priorities. More of an emphasis on spending on physical infrastructure, maybe addressing the high cost of childcare, investing more in green energy and technology. We have that reconciliation bill out there still. We don't know how that is going to necessarily end, but with the new administration, there are different goals, and ultimately that could lead to new taxes.
Right. So with that, let's touch on the fiscal component of this. So this is showing that we're expecting less fiscal stimulus.
Yes, this is a little bit of a complicated chart. So we know that the Fed, as well as fiscal stimulus, will be coming down. This is actually showing the fiscal deficit as a percentage of GDP. So during the pandemic, we saw massive fiscal support. And so we went to, down 15, 16%. We've kind of recovered to, minus 13%. So there's been a little less fiscal stimulus this year. Now I think the infrastructure bill that got caught up, that was kind of originally thought that it would have occurred already. But interestingly, the reconciliation bill, whether it's 3.5 trillion, or in this case, on this chart, the assumption is 2.7 trillion, that's going to be spent over 10 years. And so even if it gets passed, that's just, a tenth each year. And so as a result, the budget gap will actually improve, kind of like post 2008. So what is going to have to happen is the economy is going to have to step in.
Sure. Well, and I guess the one thing I always like to point out here is even though we'll have less fiscal stimulus, the fiscal deficit as a percentage of GDP is going down, which is theoretically getting better.
Right. In some ways, that's not a bad thing.
Exactly.
It just literally means that the economy is going to have to be on a sound footing and make up for that lack of
Agreed.
stimulus.
Yep. Good point. And of course, that was the fiscal side. The Fed is the monetary side. And they've talked about reducing their bond purchasing, which I believe is still at $120 billion a month, 80 billion of government and 40 billion of other.
Yeah, absolutely. And so I think there's been concern about that, but the other side of that is they're still purchasing bonds for a time. And it really is until later in 22 that those programs would really be flattening out and then at some point declining.
Right.
We're still going to have plenty of Fed support for some time.
And they're really not going to talk about raising interest rates until they get through their bond purchase program. At least that's the expectation.
Right.
Well, thank you for that discussion, Jonathan, on transitions. Let's now discuss SilverOak's outlook, both from an economic perspective and in a second from a market perspective. So on the U.S. side, tell us kind of what we're thinking.
The recovery, continues. Inflation, in our opinion, is something we should see through this year, maybe into next year. Then we'll have to kind of see where we are long term. As we've mentioned, fiscal and monetary policy, although less generous, will remain accommodative. And the other side of that is that consumers are flush.
Yeah. And I think we may have a slide in a few minutes showing that.
We absolutely do.
And on the international side?
So again, internationally, vaccine rates are less in developing countries. So to a certain extent, the recovery is going to be somewhat dependent on COVID per kind of usual, as we've said. And also outside the US, global fiscal and monetary policy will be less generous, but still accommodative. And as we've talked, China remains a wild card.
Sure. All right, and we just mentioned the consumer, so
yeah, this is a little bit complicated, but let's focus on the right. On the top, you're seeing basically the debt service ratio, and that's been declining for the last 10, 11, 12 years. That's continued in the pandemic. People are paying down their debt. Now, the other side of that is household net worth is at all-time highs, and it really has been increasing. When we look at savings rates, they're still high. When we look at consumer cash accounts across every income level, people are flush with cash.
So our market outlook as a result.
So we've talked about this. Earnings growth will continue, but moderate, and that will lead to kind of lower valuation. We will see more than likely an increase in volatility. And again, while we remain constructive, we do have a potential for a pullback. And then on the bond side, returns will be dependent from here on interest rate trends and credit spreads. And quite frankly, as you mentioned, if interest rates just kind of move higher, we're fine. But if they spike higher, that would have more of a negative impact. But again, longer term, we just expect yields to increase over time. But the other side of that, though, is bonds still provide downside protection. And we still do not believe that investors should be stretching for that higher yield and taking on that credit risk.
Sure. Well, and I was asked recently, what's a good hedge in case there is a major pullback? And bonds are the simplest and maybe the cheapest way to get a good hedge against equity market pullback. I mean, at least the type of bonds we're buying, they still provide that safety. And if there is a pullback, regardless of what's happening in interest rates, it very well could be that the pullback and the demand for bonds as a result drives the prices higher, then rising interest rates might drive the price lower. And we've seen that time and time and time again. So let's talk about market corrections, kind of similar to the vein that we discussed around mid-market pullbacks or mid-year pullbacks.
Yeah, so here, this is a little complicated, but we're looking at corrections in the market since 1950. And it also then looks at kind of where we are in an economic cycle. And so, here what I'm saying is that we're not early cycle anymore. We're kind of mid-cycle. And this is the period where you do tend to see these pullbacks, and that's the greatest frequency. Now, the green diamonds are really showing the returns that you would expect in the next year following the pullback. And you're going to see these are nice, healthy returns. The way to think of it is that we've never not recovered from a pullback. So that might actually not be that explanatory, but again, we're not late cycle. And so if we were to see a pullback and the economy continues to grow, we would expect a recovery.
Sure. Well, and I think this is going to be a real surprise to a lot of people, because what this is showing is that many companies have already had pretty significant pullbacks and are off really their highs. So walk us through this.
So basically, we're looking at the S&P 500, NASDAQ, and Russell, and we have
so U.S. large cap, technology, and U.S. small cap.
Yep. And then kind of the next group is percentage of members with at least a 10% correction from the year-to-date highs. So again, across the board, 90% or more of the constituents have had that correction. But the interesting thing is the average decline is more than 10%. So for the S&P, it's 17%, NASDAQ, it's 38%, Russell, it's 34%. Now, we talked earlier that large cap growth was actually up in the quarter. And again, that was largely because of the top 10 tech names. And so those top 10 tech names really kind of hid the underlying weakness that we saw off of highs. But that is not unusual in a recovery. You're not going to go straight up. So again, as long as earnings growth continues to grow, we would expect those companies that had that decline to recover.
Sure. Well, and we've said this a couple of times, really over the last year or so, but value continues to be undervalued relative to growth.
Yeah, absolutely. So overall, the valuation of the market is coming in, but you can just see that grayish color above the green line. That's the growth area. Just a lot of growth stocks have high valuations. And then below that green is kind of the purview of value. So even in a relatively expensive market, there are still some cheap companies.
And the other thing that we've mentioned is international, and how international is really undervalued relative to the US.
Yeah, and so generally speaking, EQI ex-US, which we use as an international benchmark, traditionally has a lower valuation. However, within its own history, it is now at a cheap level. We don't necessarily know when it will play catch up. We do believe so. Again, we mentioned earlier in the year, we thought the recovery in Europe due to the coming out of the pandemic would occur. Well, we saw Europe is up for the year, not up as much as the US, but in the third quarter did far better than the rest of the markets. But I think European recovery next year, I think could be in the cards. And then again, as we mentioned with China, it's a wild card, but if they start to see improvement, we could see the emerging markets stage a comeback next year.
Well, in emerging markets, that's one category we usually allocate only a few percentage to, because it's so wild. I mean, one year it'll be up 50%, the next year it'll literally be down 50%. Actually, I saw a statistic on China. I think China averages every year an intra-year decline of like 35%.
Wow.
Every year, an intra-year decline of 35%. That's pretty amazing. So they definitely warrant maybe a little less allocation, just because the risk associated with them can be quite high. Now, with anything, the reward can be quite high.
Right,
as well.
and the long-term case for emerging markets is the growing middle class in
Yes.
China and now starting in India.
Sure. Well, with that, let's transition over ourselves into the SilverOak update and important reminders section. So tax season is now officially over. I think a lot of people feel like April 15th is the end of tax season, but it actually isn't until October 15th for all those extended returns. Our IQ's performance update.
So generally, we are happy with the way our funds have performed year to date and in the trailing 1 year period. Now, I would say we've had exceptional absolute and relative returns out of value, especially large cap value. But again, we've mentioned international returns haven't been as high, but we've had some really good relative performers.
We've had very good relative performers
in the international side.
Yeah, I mean, as I'm meeting with folks, I basically tell them, if you're not happy with this performance, there's probably nothing that will make you happy, because overall markets have done so well the last year or two, and relative performance, not obviously 100%, but pretty much across the board has been very, very strong too. Of course, we've got exciting news that we sent a communication out about maybe a week ago, and that is that we'll be moving our office. Technically, our move is October 29th. Now, I say technically only because we have been, unfortunately, on the end of some of the supply chain issues. We've already been told one of our 2 new conference rooms will not be available till the end of November because it's not going to have any carpet in it. They can only secure enough carpet for one, not both conference rooms. And we hope they get the carpet in for the main area. Otherwise, we won't even get an occupancy permit. But it looks like, anyway, the last time we spoke with our building, it's October 29th being the move date. For those of you that accidentally come to our old office after the 29th of October, no big deal. We're literally one building away. So it's the building right next to our current building. It'll be on the 8th floor, and the exciting news is that it's more space, which is why we are moving. We are just continuing to grow, which is wonderful to see. We got a great team, and it's a growing team, and we just needed more space in our facilities, and in our current space, they weren't able to accommodate it. As far as year-end reminders go, keep good tax records for 2021. Make sure you're doing any year-end tax planning. Of course, all of our clients that we're doing tax planning for, we're in the process of completing this if we haven't already completed it. Watch out for year-end capital gain distributions. Those are starting up. Of course, with year-end coming, you'll want to make sure to get in all those year-end type of deadlines, including the annual gifting, using low basis stock maybe for charitable gifting, updating beneficiary designations, reviewing your insurance coverage, ensuring that you have proper riders. I mean, all of these things we try and remind folks of here toward the end of the year. And then, of course, we have all the tax updates, right? The new COLA adjustments, HSA updates, 401k contributions, things of that nature. Not all of these, as you pointed out before our session today, Jonathan, not all of these have been announced yet, but they will be over the next couple of weeks.
Yeah, so with the 401k contributions, inflation is part of that calculation. So we are expecting that 401k contributions will increase, not necessarily for IRAs, but with the 5.9% COLA increase for Social Security, that's incredible. It's the highest rate in like 39 years.
Yeah, no, it is. So with that, if you have additional questions, or even if you have topics you'd like us to discuss in future sessions, please reach out to your SilverOak advisor. If you're not working with an advisor, you can contact me directly. My number is listed here at 952-896-5701. Otherwise, thank you for attending today's session and have a great day.